Hey everyone, and thanks for jumping back into the Macroverse. Today, we're going to talk about the most recent CPI report, and we're going to discuss the implications for Bitcoin. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and also check out the sale on Into the Cryptoverse Premium at intothecryptoverse.com. Let's go ahead and jump in. So, these CPI reports are obviously pretty important in terms of what will the Fed's reaction function ultimately be. If you were to go take a look very quickly at what the markets are expecting the Federal Reserve to do at the next FOMC, you can see that the markets have kind of been split for a little while. It's gone back and forth between 25 basis points and 50 basis points. Before we get too far into the inflation, I will say this about what the Fed does. In order for them to cut 50 basis points, I think they're going to need to see a lot of evidence that inflation is durably going back to 2%. And at this point, I'm not sure that that evidence is clear. Okay. So we're going to talk a little bit about that. So the headline inflation came in at 2.92%. So it just rounds to 2.9. Last month, the headline number was 3, but last month inflation was actually 2.98. So it really just dropped by about 0.06%. Not a huge drop, but at least it's going in the right direction. Yesterday, the market was actually pricing in slightly more favorable odds for a 50 basis point rate cut. However, you can see that it shifted back to 25. I wonder if perhaps this is not really what the market wants to see. The reason for that is because, we've been going through the summer of the election year, and CPI has really not gone below 3% with a wide margin, right? It's still hanging out right at around 3% or so, plus or minus, 0.1%. The reason that's an issue is, and I'm sure that the Fed is looking at this, if you go back to the 1970s, which Powell has referenced many, many times, right? I mean, it's not like this is the first time he's referenced it. He's mentioned it many, many times. You can see that in the summer of the election year, headline CPI also hit around 2.9 to 3%, right? You see that? In June of 72, it was 2.96. In July of 72, it was 2.96. And then in August, it was 2.95. Okay, so remember, there's a lag on when it comes in. It's obviously August, but we just got the data for July. So June was 2.98, July 2.92. Go back to the 1970s again. Remember, it's really not that different yet. Same time of the year, between 2.9 to 3%, June, July, and August. And it probably looked back then that inflation was under control, And I bet a lot of people thought that it was going to go back down to 2%, right? Would seem reasonable. I mean, it had dropped from 6.42% in February of 1970 all the way down to 2.96% in July of 1972, so more than 2 years later. One thing I would like to mention is that the methodology that they used back then to calculate inflation has changed, or it's changed today compared to what it was back then. So it doesn't even really make all these comparisons necessarily the most fair. Sometimes when you look at these peaks over here and it looks like they're a lot higher than what we just experienced, you should know that the methodology was different back then to calculate CPI. And had they used the same calculation today as they did back then inflation would have gone a lot higher than 9%, right? It probably would have gone way up here where these other two peaks were. I did some back of the envelope math on it, I think, once upon a time, and I was looking at it. It would have been much closer to these two peaks had the methodology not changed. And it always kind of bugs me to some degree. I don't know why I'm telling you this, but my background is academia, and I just can't imagine publishing a chart, right, and putting the data out there. But at some point during the data series, you change how the data is actually calculated. But then you still put it out and compare it to all the prior data. So again, like I do have a slight problem with that because nothing like that would, I imagine, ever pass the peer review process. Okay, I mean, what self-respecting research analyst out there would start a data series and then change the methodology at some point and then just keep running it and act like it's all the same thing. So that's just a caveat. It does kind of bug me. I do think it would be good if they could at least, it's okay to create new charts, but why not continue the old one just so we can see kind of how things are going based on the way they used to calculate it. That's just me. Maybe that's just me. So again, it's great news that inflation has come in below 3%, right? Great news. But I wonder if the reason the market is struggling with figuring out if it's 25, it's going back to that 25. I wonder if it's because the market's like, well, does the Fed have enough evidence to suggest that inflation is actually durably going back to 2%? Because you could have argued it looked like that over here in the 1970s, and then we got a second wave of inflation. Furthermore, it was essentially in August, so the next month, where it also printed below 3%, and then after that, it just got right back above 3%, and in going into the next year, inflation just started going up again, right? And obviously, when inflation starts to go up, that's when the S&P starts to go down. So that, I think, is the dilemma that the Fed faces. Because, it is true that a lot of people want the Fed to cut rates, right? If you followed the whole Bitcoin dominant stuff, and if you've been calling for alt season for the last 3 years, you're basically begging for the Fed to cut rates because you probably watched your altcoin bleed a little bit longer than you thought it was going to. But you can't necessarily blame the Fed just yet because the Fed's not in the business of predicting. And it's a good thing they're not, because a lot of people that make predictions as to where inflation's going to go, they get it completely wrong. If you think back to 2022, in fact, there were a lot of vocal critics of the Fed who said that they should not raise rates above 3% or 3.5%. And a lot of them chastised the Fed for basically destroying the U.S. economy. Here we are 2 years later, and that didn't happen. So if the Fed relied on, predictions to figure out what their policy should be, they would have cut rates long ago. But as you've seen over the last several years, the U.S. economy has been able to withstand higher for longer, for at least a lot longer than people thought. So it's easy for, us armchair economists to just kind of sit over here and complain and say, well, this is how they should do it. But if you're being honest with yourself, I bet you most people would have given 1,000 reasons why the Fed should have started cutting back in 2022 or in 2023. Okay, so it's not easy, and you can't necessarily blame the Fed for wanting to make sure, because if they cut too soon or if they cut too aggressively too soon, then you run the risk of another round of inflation, which nobody here, I imagine, wants to see. Okay? Who wants to see that? I don't. Now, there is another risk as well. It's not just a second wave of inflation risk. That's not the only thing that the Fed is concerned about. They're obviously concerned about the labor market, but I want to show you what happens if the Fed stays too high for too long. Now, I've talked about this a lot before, and this is nothing new, but I just want to show you and how it kind of compares to the current markets. So if you go back to 1946 to 1949, I believe this is also a valid comparison with the current markets. Because back over here, we also had a lot of money printing because of World War II, right? This was in the 1940s. So there's a lot of money printing. And then the S&P ended up struggling for about 3 years. And interestingly enough, it swept the low basically 3 years after the top was formed, right? So the top was formed in June of 1946 or May of 1946. It swept the lows over here in June of 1949. So it was basically 37 months later. Now, the reason why this comparison is important is because if you look at the U.S. inflation rate year over year, you can see, and this is the purple line right here, I'm going to draw a line at 0. Okay, so this line right here is approximately at 0. Approximately. What you'll see is that in the same way, inflation was coming down, and it kind of paused here for a little bit around 1 to 2%, and then we got a deflationary crash, right? You can see it was a deflationary crash. So what does the Fed do, right? Do they cut too soon and run the risk of repeating the 1970s and we get a second wave? Do they cut too late and cause a deflationary crash where a lot of people become unemployed? It's a fine line to walk, and that's why, and I've said this for a long time, right? It's premature to say whether it's a no landing or a soft landing or a hard landing, right? Inflation hasn't actually reached 2%. So until it does, we can't know what the landing is going to look like. We can look at prior examples and see, all right, well, this is what it looks like when you get a hard landing because the Fed goes too far. And this is what it looks like when you get a hard landing because the Fed cuts too soon. You got to thread the Fed's trying to thread the needle. You don't have the answer for what the Fed should do to actually engineer the soft landing. Neither do I. But that is why it's such a difficult task. They have to cut soon enough to limit the labor market from sort of spiraling out of control. But you also don't want to see them go too long because then you could get a deflationary crash. And so it's really hard to say, what the Fed is actually going to achieve here. My guess, and I've said this for a long time, right? I mean, I said 5.5% was a terminal rate years ago. My guess is that they are going to be very hesitant to cut too much too soon. So it's definitely possible that the Fed could cut by 50 basis points in September, right? Absolutely possible. And if you get, a few more bad unemployment rate reads, then it's, or at least one more, right, for the next month, then yeah, like it's possible they could cut 50 basis points. But I almost wonder if it's more, it might be more favorable to just go into it assuming it's only going to be 25 basis points, because the Fed's going to need a lot of evidence to justify a 50 basis point cut. Okay, especially with the S&P, at 5,400. We made the comparison earlier to 1946 to 1949, but back over here, the S&P was not actually making new all-time highs this many days later, right? Or what? Back over here, this was 159 weeks. The S&P had not made new all-time highs. But if you go to the current day, right? If you go to the current day, you can see that the S&P has been making new all-time highs. So this is not even the most fair comparison to make between 1946 and 1949. But what I think could be a fair comparison to make, and I've said this a number of times for anyone who cared to listen about my views on altcoins, what I've said over and over and over again is, what if this is what the altcoin market is doing? What if this is what the altcoin market is how it's playing out? Because again, if you look at alts, if you look at total 3, right? If you look at total 3 and you just simply overlay 1946 to 1949, right? If you just overlay this onto the screen, you can see that there actually are some similarities in it, right? You have sort of your peak over here. You hit some lows, you hit those lows again, you hit those lows again, you get a major spike up, and then it sort of just bleeds back down. What's interesting is I said 159 weeks. 159 weeks from November of 2021 actually puts you in November of 2024. The reason why that's important is because I've said many, many times that Bitcoin dominance should theoretically top between September and December of 2024. So I really wonder if that's how it's going to play out, where the altcoin market still struggles for longer than people think, just because the Fed might not be willing to cut as aggressively as the market wants. And why should they? Inflation is still right around 3%. There's no guarantees, right? There's no guarantees it's going to immediately drop to 2%. We can think we know what's going to happen, but there's no guarantee. If they cut 50 basis points in September, you could theoretically run the risk of seeing this spiral out of control again. Be that as it may, if they go to September and only cut 25 basis points, and then what if they skip a meeting and then cut 25 again? Maybe it's not enough, and then you run the risk of a deflationary crash. So it's a really fine thing for the Fed to actually engineer. It's really hard. I'm not saying it's impossible. Okay, I want to be clear. I'm not saying it's impossible. It's just that it's very, very difficult. And it's crunch time because the market is screaming, and I've said before, if you look at the unemployment rate, a lot of people say this time's different. Right? They do. Everyone does, for the most part. It's always different in some ways. I mean, and I say that in full sincerity. There's always some differences with each business cycle. But you know what's not different? The amount of time it has taken for this whole thing to play out. Again, take a bar pattern from leading into the financial crisis and overlay the unemployment rate to this cycle. Identical. Okay? Now take it from the dot-com crash and overlay it. Oh, that's also identical. Take it from the recession from the 1980s, early 1990, and overlay that over here. Guess what? Again, same thing, right? So the unemployment rate has already entered the nonlinear phase. It is going up parabolically right now. That doesn't mean it can't have a month where it goes down. The UK just saw it go down from 4.4% to 4.2%. I'm not suggesting that it can't do that. My point here is that the unemployment rate is already screaming that it needs help from the Fed. Right? It's saying, guys, you got to do something because this train isn't stopping until you guys start cutting aggressively. But the Fed, they're over here with their hands tied because how can they aggressively cut? How can they cut 200 basis points, enough to actually make a difference, when inflation is still right around 3%? That's the issue, right? That's the issue for the Fed. So if you're wondering, right, if you're over there wondering, but why is your altcoin not going up, right? Why is it not going up? Well, for these reasons, right? All those alts, the most dubious, right? The furthest along the risk curve. In order for them to do well, you need looser monetary policy. You need quantitative easing for a lot of them to do well. We're just not getting that. And we haven't been getting that. And that's why I've said for a long time, you have to be careful with the altcoin market because it can do this. Look at Total 3. This is actually a very similar move that it did over here back in 2019 before rate cuts. Right? It gets a big rally, and then it just sort of gives a lot of it back. It's the same thing. It's the same thing. And I know it's not been a popular view, but you look back and you're like, if you go back to what people were saying back in March and April, people were calling for alt season, Bitcoin to much higher prices. And then you look back and you're like, oh, okay, that didn't happen, right? The altcoin market has been putting in lower lows and lower highs since March. And so has Bitcoin, right? And a lot of people actually turned bullish on alts up here after they already ran a lot. And I said, you got to be careful because alt Bitcoin pairs are also breaking down, which historically when that happens, alts drop about 70%. And guess what? They're already down a lot. I mean, that was back when I said it, back in March, but ever since then, they've already dropped 40%, right? It's possible for this stuff to keep on going on. Okay, so inflation. What do you do if you're the Fed? If I were in the Fed shoes right now, what I'm hoping for is I'm hoping that the September numbers look better, right? And instead of getting another 2.9, let's hope we see like 2.7 or something so that it can actually justify cuts or more cuts, more aggressive cuts. If you just get another 2.9 and the Fed gives you 50 basis points, are we not making the same mistakes? It's possible we are. I think Powell knows this. Honestly, I commend Powell for what he has done. I think a lot of people fear slowdowns in the economy. And I'm not saying, there's no reason to be fearful, right? If you have a job that you're worried about losing, obviously, it's not a good thing, right? And you want to make sure you're prepared for something like that. If you're an investor and you're worried about it, guys, those recessions or slowdowns, they just create opportunities. Okay, they create opportunities for people to get better deals on risk assets. Okay, so my thinking on it is, you know, make sure you're prepared for that, because again, you can see that the unemployment rate is going up. Now, if you look at inflation year over year per category, maybe we can get some insight. Let me just go over here. Maybe we can get some insight into what's actually going on. So again, here's what headline inflation looks like. It's been relatively sticky for over a year now. Food and beverages. Okay, it's been at 2% for a while. It's just above 2%. The Fed has achieved their objective with food and beverages, right? And you can see over here, it was right around 1 to 2% for years. Okay. So food and beverages looks okay. Housing still doesn't look that great. And the issue for CPI is that housing takes up like, what, 2/3 of headline CPI, and it's still running north of 4%. It's a lagging indicator, right? It lags, though. It always has lagged. And in fact, if you look at like headline inflation and overlay it with housing, you'll often see that headline inflation really starts to come down well before housing does. Look over here, right? Inflation has been coming down, and it took a while for housing to see that same thing. So it lags, and I think that that's, an important aspect of this. Apparel, I mean, it's at 0.185%. It's fine, right? It's, if anything, and it's too close to zero if you're the Fed, right? Transportation, 1%, fine. Medical care, 3%. It's a little high, right? But it also looks like it might be somewhat cyclical, and I wouldn't be surprised to see it, potentially start to come back down again. Recreation, fine, right? 1.37%. Education and communication, absolutely fine. 0.889%. Other goods and services, 4.23%. And really, it's been going up in May, June, and July, right? It's gone up for the last couple of months here. That's an issue, right? That's an issue. I'm not saying it won't go down. It'll probably get another big drop down at some point. I mean, there's been prior periods where it goes up for a few months and then it gets a big drop down. But again, this is the issue, is that headline inflation is not back to the target, and it can't be when you have other goods and services and housing at elevated levels. Now, again, not every category contributes the same amount to CPI. They're weighted differently. So if you go over to, say, like inflation year over year, contributions per category, and we look at what's going on. Here's headline, right? Here's headline. Hold on a second. There's headline inflation, food and beverages, right? It's only contributing 0.3% of the 2.92. It's a relatively small contribution. 1/10 of the overall CPI. Housing, look at that. It's 1.92 of the 2.92, right? It's basically 2/3 of inflation right now is coming from the housing sector. Apparel, basically nothing. No, almost no contribution. A negligible contribution. 0.00480%. Doesn't matter. Transportation, 0.186%. Still pretty low. Medical care, only contributing 0.25%. Recreation, only contributing 0.0742%. Again, not a big contribution. Education and communication is only 0.0514%. Other goods and services, while it's high, it's only contributing 0.113%. So do you see the issue? 2/3 of this is coming from housing. 2/3 of it. And we know that it lags. So it looks like a lot of the categories are where they need to be. It's just that some of the more lagging categories like housing and other goods and services are still taking their sweet time. Core inflation year over year. How does that look? It's actually been on a pretty steady decline for a long time. It hasn't looked as sticky as headline inflation. It topped out at, 6.64% in September of 2022. And ever since then, it's been mostly going down with an occasional move slightly higher. But it's back down to 3.2%, which is good. I mean, it's going in the right direction. Seems like it's heading in the right direction. Monthly change, if you look at the monthly change on it, it's been steadily decreasing, right? Maybe take a 3-month moving average. It's not decreasing as quickly as it was, a year or two ago, but it is still decreasing. So again, a lot of this stuff is going in the right direction. It makes sense, right? As long as the Fed doesn't loosen up policy and start up QE again, theoretically inflation will just continue to go down in a stochastic process. Where it becomes an issue is if the Fed starts to aggressively cut, and then it reignites all the degen spirits, leading to the wealth effect, essentially, where people start making a lot of money in risk assets. They feel rich, they feel wealthy, therefore they're more likely to spend. If they're more likely to spend, it's gonna drive up demand. Demand goes up, and supply stays constant, then prices go up. Econ 101. So, and if prices go up, then, you have more inflation. And if you have more inflation, then you have to worry about what the Fed's going to do to tame that inflation. So that's the update on inflation, right? That's the update on inflation. And if you look at something like Bitcoin, it's been struggling, and we talked a lot about how it would likely get a rally into its death cross. I mentioned that many, many times. And, ta-da, right? You rally into the death cross right here. Bottomed out at 49K, rally right up into the death cross, struggle to get back above that 50-day SMA. Okay. I'm not saying it can't. One of the things to note is that it did, Bitcoin at least did fill the gap. Bitcoin futures, there was a gap right here at 62.5. It filled that gap. ETH hasn't filled it yet. I don't know if it will, but if it does, it means 3K at some point. But again, that doesn't have to happen immediately. It could still be weeks or months away before something like that theoretically happens. So those are that's the year update on inflation. And I think that going into the end of the year is going to be an extremely volatile time for the markets as the markets try to parse what's actually going on. Is it a soft landing? Are we going to see inflation go back up? Are we going to get a deflationary crash? My guess, if I had to guess, and I put out, I've talked about this all year, and I put out a tweet outlining this at the beginning of the year. My guess is that in the short term, there's a higher risk of a deflationary crash than a second inflationary wave, because I think Powell is going to try to do what he needs to do to make sure that doesn't happen. Now, next year, you could have a deflationary crash, and then it look like it's going to be really bad, and then it not be as bad as people think. And then you get another round of inflation that's maybe not as bad as in 2022, but it could be sort of a lower high on inflation, in like in the next business cycle. But I do wonder if that's how it's all going to play out, and it would be kind of interesting if it did, because I've said before that the most likely outcome is for Bitcoin dominance to top between September and December of 2024. And it's going to top because looser monetary policy arrives. It hasn't arrived yet. Therefore, my base case is that alts keep on bleeding back to Bitcoin. That's my base case. And therefore, I think that Bitcoin dominance will continue to go higher. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and again, check out the sale on Into the Cryptoverse Premium at intothecryptoverse.com. We actually have 3 additional videos for the highest tier, 3 more videos each week, so make sure you guys check that out. And also, we have a Telegram channel and trading view indicators, and obviously more than just inflation charts. We got thousands of different charts, not only for cryptocurrencies, macro, but also for equities as well. And I honestly don't really do the website justice and talking about it enough. But there are a lot of tools that you can use to try to figure out what's going on in the markets. And for those that wish I talked more about altcoins, just know that while I don't talk about them as much in recent years, we have an asset filter up here where you can pick out an altcoin. Let's say you want to pick out Ethereum, and it'll just pull up all the charts we have on the website for Ethereum. And you can do that with a lot of different cryptocurrencies. So just be aware of the tools that we have. We've spent a long time building out this thing, not only for crypto, but also for macro and equities as well. Thank you guys for tuning in. Subscribe. Again, links in the description below. Lock in the low rate, and I'll see you guys next time. Bye.